Breaking news on a major economic shock hitting North America. Donald Trump's announcement of a 25% tariff on Canadian steel and aluminum is sending shockwaves through the automotive industry. Starting March 12, this move threatens to reshape U.S.-Canada trade relations. The numbers are concerning. U.S. automakers face $22.4 billion in additional annual costs. Ford projects a $1 billion yearly increase in expenses. Industry experts warn that vehicle prices could rise by $800 to $3,000 per unit. Canada's response is decisive. Prime Minister Justin Trudeau announced a 100% tariff on Tesla vehicles, targeting Elon Musk, who supported Trump's decision. Tesla's Canadian sales dropped 70% in January 2025. The effects spread beyond automotive. 45,000 American auto jobs are at risk as production slows. Canadian consumers are boycotting U.S. products and travel, causing a $2.1 billion loss in tourism revenue. States like Florida and New York are already impacted. The integrated North American auto manufacturing system is under threat. Most vehicles cross the U.S.-Canada border multiple times during production. With Canada supplying over 50% of America's aluminum and nearly 20% of its steel, these tariffs could disrupt supply chains. The energy sector faces challenges too. Canada provides 44% of America's imported oil, and retaliatory measures could increase U.S. gas prices by 30%. Border retail businesses report declining sales. Canada's retaliation includes tariffs on dairy, beef, corn, and soybeans, targeting Trump-supporting states like Wisconsin. The message is clear. This trade war could escalate further. The question remains, will these measures force a policy reversal, or are we seeing the start of a prolonged economic confrontation between longtime allies? Breaking news. Trade tensions escalate as Canada proposes unprecedented Tesla tariffs. In a significant development reshaping North American trade relations, Canada's response to U.S. steel and aluminum tariffs has taken an unexpected turn. The proposal of a 100% tariff on Tesla vehicles represents one of the boldest retaliatory measures in recent economic history. Industry experts warn this move could revolutionize the electric vehicle market. We're looking at a potential reshaping of the entire North American automotive landscape, says Dr. James Morrison, senior economist at the Global Trade Institute. These tariffs wouldn't just double Tesla prices, they could fundamentally alter consumer behavior. The ripple effects extend beyond Tesla's bottom line. With the company dependent on Chinese manufactured parts, they're caught in a perfect storm of rising costs. This situation becomes more complex when considering the broader U.S.-Canada trade relationship, valued at over $700 billion annually. The timing is crucial as both nations push for carbon reduction goals. Higher EV prices could slow the transition to electric vehicles, potentially derailing environmental targets. Market analysts suggest this could lead to a 30 to 40% decrease in EV adoption rates over the next 5 years. The proposed tariffs have triggered responses from other automakers. Ford and General Motors are reassessing their EV strategies, while international manufacturers watch closely, seeing an opportunity to gain market share. Early projections suggest potential job losses in both countries' automotive sectors, with supplier networks particularly vulnerable. Small businesses and border communities might face immediate impact, as changes in cross-border shopping patterns could affect local economies. Tesla's stock has shown unusual volatility as investors process these developments. This situation continues to evolve, with both nations' officials engaging in negotiations. The outcome could determine not just the future of EVs in North America, but the broader framework of U.S.-Canada trade relations for years to come. Breaking news. Canada takes unprecedented stand against U.S., rejects 51st state comments. In a dramatic escalation of tensions, Prime Minister Justin Trudeau has launched a fierce response to former President Donald Trump's controversial suggestion that Canada could become America's 51st state. Trump's remarks at Mar-a-Lago in December 2024, suggesting Canada could join as 2 separate states, have triggered a nationwide boycott movement across Canada. The Canadian response has been swift. Provinces including Quebec and Nova Scotia have removed American-made alcohol from retail shelves, dealing a blow to U.S. producers, particularly Kentucky's bourbon industry. This boycott extends beyond spirits, potentially costing the U.S. billions in lost revenue. Canada has proposed a 100% tariff on Tesla vehicles in retaliation to Trump's 25% tariff on Canadian imports, excluding energy products. The automotive industry, with $50 billion in annual cross-border trade, faces unprecedented disruption. The tourism sector is experiencing impacts. With over 20 million Canadian tourists typically visiting the U.S. annually, popular destinations are reporting substantial losses. Industry experts warn this could lead to job cuts in American tourist regions. Canadian officials emphasize their willingness to work cooperatively but maintain a firm stance against economic threats. "We're prepared to respond decisively to any tariffs," stated a senior Canadian trade official, highlighting the country's commitment to protecting its sovereignty. This situation represents the most serious challenge to U.S.-Canada relations in recent history. The economic implications extend beyond immediate trade impacts, potentially reshaping North American economic partnerships. As Canada explores new trade relationships, particularly with EU electric vehicle manufacturers, the U.S. risks losing its privileged position in the Canadian market. For additional updates on this developing story, stay tuned to our channel. In a dramatic escalation of North American trade tensions, Canada's proposed 100% tariff on Tesla vehicles could reshape the entire electric vehicle landscape. Our analysis reveals the far-reaching implications of this bold move, which extends beyond Tesla's immediate market concerns. The numbers have industry experts worried. Tesla, commanding 70% of the U.S. electric vehicle market, faces a potential price surge of $5,000 or more per vehicle in Canada. A Tesla Model 3, now priced at $40,000, could skyrocket to $80,000, pricing out most Canadian consumers. This isn't just about Tesla. The North American auto industry stands on shaky ground. With Canada producing over 2 million cars annually for U.S. export, potential factory shutdowns could leave hundreds of thousands jobless. The Canadian auto industry, valued at $50 billion annually, faces unprecedented challenges. Donald Trump's recent decision to reimpose a 25% tariff on steel and aluminum imports from Canada and Mexico adds complexity. Canada is responding by redirecting its focus to European LNG exports. Industry analysts suggest this could be Canada's opportunity to reshape its economic destiny. Rather than retaliating with counter tariffs, Canada appears to be playing the long game, transforming a trade crisis into an energy market opportunity. The electric vehicle revolution could face significant setbacks. Tesla's plans to sell over 1 million cars globally this year, including 50,000 in Canada, may need revision. Market experts warn of possible declines in Tesla's stock value as revenue projections face pressure. This uncertainty extends beyond Tesla, potentially slowing the electric vehicle industry's growth and complicating global emissions reduction efforts. In a significant shift in global energy dynamics, Canada is positioning itself as a major player in the international LNG market, particularly targeting European consumers seeking alternatives to Russian gas supplies. Prime Minister Justin Trudeau's recent statements highlight Canada's strategy to reduce economic dependence on the United States while establishing itself as a reliable energy partner for European nations. "We're seeing a transformation in global energy partnerships," says energy analyst Marcus Thompson. Canada exported 6 billion cubic meters of LNG in 2022, and that's just the beginning. With projects like LNG Quebec potentially coming online, we could see those numbers double soon. However, this Canadian energy pivot faces challenges. The International Energy Agency, IEA, reports that shipping LNG from Canadian ports to European terminals costs about twice as much as U.S. shipments. The logistics are challenging, with Canadian shipments taking 13 to 15 days to reach European ports, compared to 5 to 7 days from U.S. terminals. These costs could impact European consumers. Industry experts project that LNG prices could rise by 10 to 15% if European nations increase their reliance on Canadian supplies. This price hike would affect millions of European households through higher electricity and gas bills. Despite these challenges, the strategic benefits might outweigh economic concerns. Europe's determination to diversify energy sources away from Russian supplies has created an opportunity for Canada. With its vast natural gas reserves and growing export capacity, Canada stands to become a crucial player in the global energy market. This development comes as North American trade relations face pressure from potential U.S. tariffs on steel and aluminum. Canada's energy strategy appears to be part of a broader economic diversification plan, reducing its vulnerability to U.S. trade policies while strengthening its global market position.